Welcome back, everybody, to Phenom Group's weekly State of the Market. I'm your host, Seth Golden, and we're getting a bit of volatility in the markets today on headlines breaking about hour and a half ago concerning capital gains tax and income tax on the wealthy. And I guess what we have here today is nothing short of I think the colloquialism is throwing the baby out with the bathwater. Essentially, indiscriminate selling. Let's just dive right into it. Given the price action of today is rather frightening to some, opportunistic to others. Given that it is rather indiscriminate selling that's taking place here today. So I want to kick things off with a famous quote from Howard Marks. Prices are too high is far from synonymous with the next move will be downward. Things can be in an overpriced way for a long time or become that much more overpriced. We continue to hear this drumbeat of investors and traders that believe just because price has elevated, just because valuations are stretched, just because sentiment is too frothy, that has to mean that the market rolls over. And that's just not necessarily the case. Additionally, there's no real utility in that sentiment or belief system, if you will. You don't know when price is going to roll over. You don't know what degree it's going to roll over or consolidate, if you will. Ideally, your best positioning is to have cash on the sidelines, a game plan intact that you're ready to deploy. Speaking of indiscriminate selling, this quote here, indiscriminate selling is the biggest source of pain in the market, but it is also the biggest source of opportunity. So with today's headlines triggering a pretty good sell-off here, more than 1% across all major averages except for the Russell, are you taking advantage of that opportunity, or are you sitting on your hands fearful that, well, we've got to go even lower? This will probably bleed into the next trading day. The reality is maybe it will. But does that exonerate taking advantage of what most people want anyway, which is better valuation, better price entries, if you will, buying low, selling higher? Today, you're getting the opportunity to buy lower. Are you taking advantage of it? So we came into this week basically at all-time highs, closed at pretty much all-time highs last Friday. So this chart right here from Hedgepedia, shortly after rising to new highs last Friday, March 20 trend line here, as you can see, once again being tested. This week, first two trading days of the week, Monday, Tuesday, we had a bit of that consolidation that we had been talking about over the last 2 weeks. Again, we don't know when the consolidation is going to show up. We don't know to what degree it's going to show up. We just know that it will eventually show up, given a lot of the different sentiment and breadth readings that we've been heralding over the last couple of weeks. So here we are Monday. We had a pullback. And then on Wednesday, we just started rocketing higher once again. So that's kind of the way it goes. You get these brief moments of market malaise and negative sentiment, and all of a sudden the flows come back, and investors are right back to the tried and true buy the dip. Coming into this week, the S&P 500 has not had a back-to-back down day in the month of April. And so Monday and Tuesday was the first time. The NASDAQ has had two prior to coming into this week, but the S&P, none. So this is the first back-to-back down day of the back-to-back down sessions of the month of April. So looking at again, one of what's getting the most attention is breadth lately. Breadth being as extreme as it's been. While indices moved lower Monday and Tuesday, and this kind of went under the radar. While indices moved lower Monday and Tuesday, the percent of S&P 500 stocks above the 200-day moving average made a new high at 96.6%, which was the highest reading since 2009. So the S&P 500 pulled back a good 1.2, 1.3% over the course of those 2 trading days. The high was 41.91 last week. The low this week on Tuesday was 41.18. So a good we'll call it 1.3% pullback. And yet the stocks trading above the 200-day moving average made a new high at 96.6%. That's what you see down here. This is the breadth reading, percent above 200-day moving average, 96.6%, folks. There's always something, good to take out of any trading day or any trading week. This was a bullish, point of emphasis that should serve to, validate the dip buying activity that we have seen consistently. Now, what does breadth say? If breadth is deteriorating that much further, then you kind of hit the pause button and see how price action develops from there. But this wasn't the case for this this is the longer term breadth reading, 200-day moving average. That is a long time frame. But this basically validates the uptrend. All right, now here's another one. This is also looking at the 200-day moving average, the percent of stocks above the 200-day moving average. We talked about this particular study from Troy Bombardia back in February, because in February, we had the percentage of stocks trading above their 200-day moving average at greater than 80% for 61 consecutive days. Again, this goes back to February. And you can see what the forward-looking returns are when you have this kind of breadth in the market, a month later, 2 months later, 3 months later, and the positivity rate is very strong. We talk about the aligning yourself with the probabilities. This particular breadth study says we should have been higher a month later than this signaled on February 5th. Were we in March? Yes, we were. 2 months later, April 5th, have we been higher in April? Yes, we have. So this one has come true over these, this 2-month period as well. 3 months later will take us into the month of April, May. But here's the kicker. We're already up this 6+, but we're up more than 7% since this fired. So have we pulled forward, some of these gains that you're supposed to see over a 6-month period? You could make the argument, yes, we pulled forward some of those gains. So we got to be open to the possibility of there being some turbulence here in the near term, but we'll see. Now, here's the other thing that's because in March, by March, we had a decent correction, 5.6, 5.7% at the end of February into the first week of March, where we troughed and then started accelerating to the upside. Well, it was at that time that we actually saw this breadth indicator dip below 80% of stocks trading above the 200-day moving average. So we had a reset, right? We had a reset. I mean, it went for a long time, and then this dip below 80% of stocks. But since then, on March 9th to the present day, we spent 44 days in a row. Now, 44 days in a row. Again, we're running a new streak here, folks. 44 days in a row, we've been above the 200-day moving average in this breadth indicator. And you can see right here, dips just below the first, little after the first week of March. And we've been above this ever since. We're on a new streak, and that's why this particular study comes back into focus, and that's why we're reviewing it here again today. Because if we go 61 days again, well, we're back to 1 month later, 2 months later, 3 months later in the forward-looking returns. So your breadth studies, review them, keep them handy, know your, statistical data, if you will, your quantitative data. All right, we talked about this chart just last week, 2 weeks ago. And this is one of the reasons why we anticipated some consolidation, being more than 2.5 standard deviations above the 50-day moving average. We tend to see consolidation, and we have. We dropped back from 41.91 to 41.18. Who knows where we're going to finish today? The market's under pressure. We may drop to 4,100, break 4,100. You just never know. What we do know is that price is very sensitive at these levels. Price becomes that much more sensitive. Proof is in the pudding. We get a headline today and price starts to deteriorate. The sellers come out of the woodworks. Again, though, opportunity, right? We talked about the 618 Fibonacci projection of, the advancement level coming in at 4136. That possibly being because the last time we got here, we did correct. We usually do correct. And we did this time, but we still went higher first. We went higher first before we corrected. That's why I say you shouldn't be hedging. You shouldn't be looking to short the market because you don't know how much higher we're going to go before the consolidation actually happens. This study right here takes, again, frothy sentiment. You see the AAII survey. You get the intelligence poll. And this particular one shows the S&P 500 returns by all-time percentile ranks of investors' intelligence, the II survey that comes out every week, investors' intelligence poll, the bull versus bear spread. You take the bullish sentiment minus the bear sentiment, you get a spread. So the bulls minus the bears percentage came in above 40%. Comes in above 40% for the second consecutive week with 63% bulls and 17% bears amongst respondents. This reading puts the bulls minus bears in the 90 to 99 percentile. S&P 500 forward returns are rather muted going forward historically. Again, just about probabilities. Keep an open mind. We're not looking at, huge declines here, folks. But it's another interesting study that kind of speaks to sentiment. Last week, we looked at some of these. These particular studies are about the 50-day moving average, the percent of stocks trading above the 50-day moving average. So I'll try to run through it rather quickly here. These were from Thrasher Analytics, Andrew Thrasher. And you see the blue lines are basically the times where the percent of stocks above their 50-day moving average got to 85%. And that's where the line going across here is 85%. And more recently, it was above 90% recently. So kind of reading through these notes here, currently this was last week, currently 89% of stocks are above their 50-day moving average, with each prior occurrence of 85% plus marked in the blue lines. This suggests that if we do see the market begin to respond to the elevated sentiment, the strong breadth figures should help blunt any downside damage. And here's the key here. Look at where the blue lines are and how the market continues to trend higher. And when we have these little, gaps in between the blue lines, they're very muted drawdowns. Where you tend to get the bigger drawdowns is when the gaps are wider. You have this bigger drawdown here, this bigger drawdown here. But then you get up to that significant threshold reading in stocks trading above their 50-day moving average, and you have a really muted one here. Here, a lot of white space, bigger drawdown. Somewhat, modest drawdowns here, but the longer we go, bigger drawdown. But this was the pandemic, of course. So, when you get these good breadth readings, you tend to have modest drawdowns, maybe 5%, 6%. But 10% is really difficult when the percentage of stocks trading above their shorter term moving average, the 50-day, not the 200, but the 50-day. It's basically telling you there's a backstop. There are investors that are willing to buy at the 50-day moving average, if not a little higher. That's how you get this breadth reading to stay at these levels or near these levels. Here's another study. This one comes from Chris Shavako. Same thing, S&P 500, the stock's trading above their 50-day exponential moving average. Here's your line in the sand, basically 90% of stocks trading above their 50-day moving average. When this happens, when this breath indicator fires, historically, these are your returns going forward. 1 month, 2 months, 3 months. You know, you could expect some chop here, right? Especially 1 month out. The average return based on 1, 2, 3, 4, 5, 6, 7 occurrences, the average return 0.53. Now this last fired on the exponential moving average last year, the month of, that's looking like June 5th, 2020. We were pretty much positive across the board here. 1 year later, because, well, we're almost 1 year later, and in 2 months we'll be in June. 1 year later, the average return is 11.67%. The market is higher 100% of the time. What I hate to tell you though is we've already generated more than, we're up more than 20% from this signal here. Point is, it has come to fruition. Breath is that strong in the market, folks. And again, bigger corrections are really tough to come by when you have, you know, breath this strong. It essentially takes a catalyst. You need something out of the norm to catalyze a full, you know, textbook 10% correction. Is it this tax headline today? Could be. Could be. I don't know. Nobody does. Everybody would guesstimate, but in my opinion, there's about a, right, because nothing's impossible, and if I say there's zero possibility of this particular tax proposal passing legislature, people will get upset. So I'm going to give it a 1% probability. Phenom Group did an entire special weekly state of the market last year ahead of the election period, where we talked about the tax implications for not only the election, but, you know, the economy going forward, as well as the stock market. So if you're not a member, subscribe so you can have access to that. If you are a member, of course, go back to just prior, the week before the election. It's called the Weekly State of the Market Election Special. Check it out. But I gave it I give it a 1% probability that this particular proposal will actually find its way even to the floor. These things go through negotiations well before they ever hit the floor for an actual vote. Secondly, this is a ploy. Kind of think back to the trade war with China. Like, how did the White House administration then, the Trump administration, combat stock market declines? Well, came out with a headline pretty much every couple of weeks regarding the relationship between China and the United States. And we saw the market correct positively based on those headlines. Well, the big issue here in 2021 is not China trade war, really. It's rates and yields, treasury yields. If you go and do a correlation, if you attach the headlines, if you go back and look at any headline that has come out since late 2020 into 2021 with the tax wording, you'll see what happens to yields. Go look at yields for each one of those days. That's all this White House administration is trying to do. Temper down rising yields. And it's working. We were up 2+ basis points, almost 2.5 basis points on the 10-year earlier today. The tax headline came out, and lo and behold, we erased it. We were down more than 1 basis point. We're now down 1 basis point. Get used to this, folks. Also, as I said before, what are you doing? Like, what are you doing? You sitting on your hands? Do you have a game plan for this kind of indiscriminate selling that we talked about as being a really a big opportunity? You wanted cheaper prices, you got cheaper prices. Execute. It sounded like my father right there. I'm so sorry. And I have my Slurpee. You know, everybody, you have to have a Slurpee when you're doing the SOTM now. And if you're watching the SOTM, I beg of you, have your, so this is my Jesus juice, or my Bible juice, as I call it at home. I also bring one to church with me all the time, and people are like, yep, Seth's here. You know, he's got his Jesus juice with him. Obviously that's not healthy, but what are you going to do? It's one of my vices. That and Cheetos. Those are my vices. I go to the local Circle K before I go to church. I get my Slurpee and I get my bag of Cheetos. And I don't share. I can't when the bag's opened. I have a really weird thing. If the bag is opened, I cannot share. Not even with my kids. My wife knows that. It's a weird, I don't know. It's just, there's something that happens when that bag opens that screams dirty and germs. And so I don't share with anybody. It is, we're getting off on a tangent here now. All right. So you're going to get to know me a lot better over the coming months and years. All right. Anyways, NASDAQ. Let's talk about NASDAQ, baby. No, I'm not going to sing either. Okay. Here's where the NASDAQ came into the week. Same thing. We came under pressure. We got above 14,000. We were threatening, all-time highs on the NASDAQ. The NASDAQ 100, however, did make new highs, which speaks to kind of the different composition there. But then we had a pullback, and then we had a really nice rally yesterday, and we're pulling back here once again today. Some notes here: Apple, Microsoft, Amazon, Google, Tesla, Facebook, they're all going to be reporting next week. It's going to be a big week for the NASDAQ 100, folks. Those 6 names account for 45% of the NASDAQ 100. As they go, so goes the markets, folks. Netflix has already reported. Unfortunately, that was met with some dismay, if you will. As I talked with our members in the trading room at Phenom Group, I think it's an opportunity longer term. Right now, I don't want to own it. I want to trade it. The reason why I don't want to own it is because I don't want to be in too many dog fights when it comes to stocks that I'm invested in. I own Alibaba. I took that one out recently. I know that's going to be a dog fight. I'm willing to fight that one, but I'm not willing to fight with Netflix the same way. Something you have to consider as an investor is there easier money to be made elsewhere? The risk reward there is for Alibaba. And that's why I'm willing to fight with that one. But for Netflix, I can't really see it the same way. I do see it going higher longer term. There's no other way to see it. That's what the stock has done. You can argue fundamentals all day. You can argue technicals till you're blue in the face. The reality is the chart shows you. Long term, the stock goes up. It's been consolidating here now for the last 6 months. I'm of the opinion that the fundamentals are still showing you growth, 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 growth. Problem is they missed analyst estimates. We're in this period where the comps, what's the rate of change going to be when it comes to those subs? There was an abnormal rate of change given the pandemic and the shutdown last Q1, because we shut down late February and March. I mean, those subscriptions just went through the roof for Netflix. You shouldn't expect that same thing in the first quarter of this year when we are reopening, when people are going back to work. You're not going to have the same rate of change when it comes to subscriptions. I think it's just it's been very tough for analysts to model. Nonetheless, growth, that's all they reported, which is why I say it's just going to take some time for the analysts to get accustomed to the cadence of the different metrics going forward in an economy that is reopening and will eventually fully reopen. With that being said, we'll move on here. This particular chart, NASDAQ 100, this is the stocks trading above the 20-day moving average. Talk about your fast of the fastest moving averages. This is pretty close. Not 200, not 50-day, but the 20-day moving average. What's important here is during this latest run with the NASDAQ 100, QQQ, right? Ticker symbol QQQ. This latest run took this particular breadth rating to a level that it has not seen in, this whole chart. This goes back 6 months. So these new highs were supported by breadth. The 20-day moving average, was this overbought? You can make that argument. Usually when you get to these levels, you do see a dip in the index itself. Get up to these levels, you do see a dip in the index. Got up to this level here and tiny, but then took off again, got even higher, and we do see a dip here. Having said that, on yesterday had a significant bounce in this breadth, and this one tells us there's buyers here still. They're not full on selling. They may be waiting for these earnings to come out. Good breadth here, though. That's the bottom line. There's good breadth here. Buy your dips, folks. Buy the dips. Other people are. Do it tactically, strategically, in accordance with a game plan so that you can fairly give yourself room if there is further downside pressure. We can't exonerate, the reality that there's always going to be a probability for another 10. The NASDAQ 100, they tend to deliver more 10% corrections than does the S&P 500 because of the names that are in there, because of their market cap weighting, because of the beta associated is higher than the S&P 500. So for the NASDAQ 100, the percentage of stocks trading above their 20-day moving average showed signs of the index getting to overextended levels at 85%. A quick 2-day sell-off served to alleviate some of those frothy conditions, but was found with an even stronger snapback in the index with strong breadth. The NASDAQ McClellan oscillator below shows the strength of Wednesday's snapback in the NASDAQ. This is a NASDAQ McClellan oscillator, and you can see right here. It's basically a advanced decline line metric, if you will. And you can see it got down to this trend line here. And this is another one where you say to yourself, it's not making, this particular breadth metric is not generating lower lows. Until it does, you should be in buy the dip mode, looking for those opportunities. This is suggestive. If you take these two together, this suggests that NASDAQ 100 has a likelihood of achieving even more highs in the not too distant future. Again, this is, absent some kind of exogenous event or, catalyzing headline. And again, I don't know if today is that headline that forces investors to second guess on, en masse. We'll find out soon enough. If we don't snap back from this tomorrow, we'll know. We'll have the information. Charts are a developing situation, folks. They tell us what happened and what is taking place presently. They don't give us, unfortunately, they're not a crystal ball into the future. Monday and Tuesday marked the first back-to-back down sessions for the S&P 500 in April, and just the second for the NASDAQ. Wednesday's rally was not deemed a dead cat bounce, given the broad-based participation, breadth, strength, as indicated in the NIMO chart above. Again, this is your advanced decline line readings. And you can see here, this is a snapshot of the NASDAQ and the NYSE advancers versus decliners. And I mean, more than 3-to-1. We had more than 3 NASDAQ stocks advancing for every one that was declining, like 3.2, 3.3 here. And it got even better when you look at the volume. This is the volume, share volume advancing versus declining. 3,700 advancing volume versus only 417 declining volume. Million versus hundreds of thousands, okay? So the tail of the tape, the table for the NASDAQ and the NYSE is detailed above. The table identifies the advancing versus declining stocks. NASDAQ AD was roughly 3-to-1. New York Stock Exchange was almost 4-to-1. The volume was even better. In this chart right here, Wednesday, the advancing volume was 88% for the NYSE, meaning 88% advancing volume, and 88.7% up volume on the NASDAQ. That was the best NASDAQ volume advancing reading since January 4th of 2019, as indicated right here with the arrow. We went down on bad breath, don't get me wrong. We did go down on bad breath Monday, Tuesday. But the breath snapback was even better than the down days. That's something to take to the bank, folks. What about yields, right? This chart right here, there's literally no correlation between the NASDAQ. Everybody said, well, tech and the NASDAQ, you know, if yields go up, the NASDAQ, this is it, folks. This is your NASDAQ 100, and this is the correlation. There's literally a negative 0.5083 correlation with yields. It doesn't exist. There's no correlation. I know in real time, you know, you can see, I mean, I get it. You can see yields going higher and the NASDAQ underperforming. I get that. But the thing is, when the NASDAQ snapped back, it erases all of that. Even if yields are flat, slightly down, even slightly up, the NASDAQ's rally overcompensates for those momentary connections to what yields are doing. All right, with that being said, small caps versus large caps, right? Like that's been the running. If it's not the NASDAQ versus yields, it's small caps versus large caps. Those are kind of the dueling narratives that we've seen here in 2021. Well, it goes back to, you could say, late 2020, but it's persisted here. Until recently, you know, we've had our Russell correction, our small cap Russell 2000 correction. That was down good 10, 11% recently. That corrected and large caps took over. And that's basically what we see here in this chart. The Russell 2000 ETF versus the S&P 500. And after many years of outperformance, large caps have lagged. Again, this is the Russell improving against the S&P 500, really improving until about mid-late February. And then the S&P 500 took over and the Russell underperformed, continuing to underperform. It's underperforming the NASDAQ as well. There was a 13.1% year-to-date gain gap between the Russell and the NASDAQ. I actually tweeted it out just the other day. See if we can find it really quickly for those of you who don't follow me on Twitter. Yeah, right here. Look at this. At its worst, the Russell, the spread between the Russell and the NASDAQ was 13.1%. You fast forward to 2 days ago, it was only 3.8%. That's how quickly this has corrected, with the NASDAQ accelerating to the upside, bridging that gap. So, you know, all the people coming into this year expecting small caps, value over growth, expecting that to just continue into perpetuity, they might be second guessing that at this point. Investors get prisoner of the moment, analysts, prisoners of the moment, economists, market commentators, market watchers, prisoners of the moment. You know, you see what price is doing and you tend to, you know, gravitate toward that belief system and even trade in accordingly. But usually this is not the way it works out. At some point, you know, we're going to move from one cycle of this bull market to another cycle. And investors are going to want stronger, quality-driven balance sheets. It's not what you're going to get from value and or small caps. So keep that in mind. All right. Some of you may not like this, but I'm going to say it anyway. The following chart commentary comes from Carter Braxton Worth of Cornerstone Macro. He's the certified market technician for Cornerstone Macro, and you've seen him probably on CNBC many a times. Jesus juice just to get this whole segment out of the way here, because I am going to laud, I'm going to give kudos to Mr. Carter Braxton Worthless, as he is otherwise known, because a lot of his calls, they just don't pan out. I wish it was something like, he had even a 300 batting average, but it's far less than that, based on my experience and watching him over a number of years, whether it's on CNBC or following his Twitter calls and what have you. But this chart right here, he had issued back on February 17th. And this is the 5-year relative chart back on February 17th, the Russell 2000's relative performance to the S&P 500. And again, look at it now. Russell 2000's relative performance more recently. It's fallen apart here to the 150-day moving average. Will it bounce? Will it find support there? We'll see. It might. This was his tweet. The Russell 2000 unwind is on schedule and well underway. The key question is whether the mean reversion is complete. Our thinking is no. We want to continue to be underweight small caps relative to large caps. Growth stocks have been outperforming value stocks since 2006. Growth has outperformed value since 2006. That basically presages FANG. I mean, Facebook wasn't public then. Google wasn't public then either. So this is pre-FANG, and still growth did better than value. Growth stocks have been outperforming value stocks since 2006, but the ratio of growth to value peaked last September and hit an 8-month low in early March. So I'm giving credit where credit was due. He was right. Carter nailed this call, which Phenom Group also found in favor back in February and prior to the public dissemination offered by Carter Worth. Carter made another call in early March, shown below. This was his tweet, March 4th. Speaks to the NASDAQ. We want to be long, large cap, marquee NASDAQ stocks versus smaller NASDAQ stocks. Indeed, every single time the NASDAQ 100 has underperformed the composite, see, before the NASDAQ was actually leading the NASDAQ composite, but every single time the NASDAQ 100 or the QQQ has underperformed the composite to the point where the ratio touched the pink uptrend line, the QQQ or NDX has come to life relative to the overall composite. I blew up the chart for you, showing you the pink line, the NASDAQ 100 index relative to the composite index touched the pink line to the penny and has bounced since then. So while the NASDAQ composite index has not hit a new all-time high, it has to get to 14,176, and it hasn't been able to yet. Got to 14,035 and 14,050 recently, but not a new high. Yet, the NASDAQ 100 has. And again, this was from March 4th. Like I said before, Phenom Group I didn't need this chart. I didn't need his tweet. I'm glad they validate what I was feeling and what I had disseminated to our Phenom Group members in our weekly research report. For those of you remember this, recall from Phenom Group's February 28th research report. Is the 28th before March 4th? Yeah, of course, okay. When I review what has taken place with yields year to date and where the greater value is to be found at this point in the reopening cycle, it would not surprise me to see continued strength from financials and small cap stocks in the interim. Longer term, I'm favoring a market that is largely pricing in the economic reopening and will revert to former technology, dividend paying, and cash flow leadership. What has better cash flow than technology, than consumer staples and consumer discretionary? I believe the easy money trade is near completion. Small caps, value, financials, reopening. industrials, materials, so on and so forth. Waiting until then to own this area of the market, however, will likely find investors missing the bigger moves from technology and other beaten down sectors like consumer staples. Given this expectation and assuming the continued, if not accelerating pace of the vaccinations, what happened after we made this call? Consumer staples have now made consecutive new all-time highs. What happened since February 28th with technology? The XLK has made a new all-time high. What happened with FANG, Microsoft, Facebook, all-time highs recently. Amazon got back to 3,400 plus recently. Google, new highs. The NASDAQ barely missing a new high. NASDAQ 100, new highs. Again, I didn't need this, but I'm glad to have it. It's validation of what I was feeling from fundamentals. Having a feel for the market, following sector performance. I'm disgusting. I have this all going on in my head on a daily basis. Try sleeping next to me. Good luck with that. Again, Jesus juice. All right. But again, I am thankful, this is, resourced information that validates what I was feeling back then. I've been doing this 22 years, have a very good sense or feel for what's going on in the market. And yeah, unfortunately, it reverberates and ping pongs off my head on a daily basis. So here was our final statement from that report on February 28th. I am currently building positions in individual stock names like Apple, Pepsi, and we'll look at some leveraged ETFs like TQQQ and potentially SSO in the very near future for the Golden Capital portfolio. With that said, let's look at our final weekly study data update. I think we beat Carter Worth to the call, but either way. And, this is, again, what has Apple done since that time period? 119, 118, up to 135 just the other day. Pepsi, 127, up to 147 just yesterday. $20 move in Pepsi. Consumer staples, technology. TQQQ, $70, it dipped under 70. 70 to 113 just a couple days ago. And we've been trading that like a beast. Let's see here. Our first trade that we disseminated to Phenom Group members, and this is our spreadsheet of all the trades that we do daily and throughout the course of the year. Our first official trade alert to our members on March 3rd, TQQQ, $84. These are day trades that we're profiting from. On the 3rd, we actually did 3 of them. 1, 2, 3, 4, 5 of them on this particular day, or 4 of them on this particular day. March 5th, 2 more. These are scalps and swing trades that we use to develop a core holding. So every time, let's say you have 100 shares, sell 75, keep 25. Get the next scalp, sell 75, keep 25. Eventually you build up a position that you want to hold for longer term. We got a cost average to basically $60 a share. And we've just, continued TQQQ, 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 TQQQ. It's hard to say fast, especially TQQQ, and just so on and so on and so on. We've actually done more than 115 trade alerts already this year, I think. 99% hit rate. Yes, 99%, folks. All right, technology sector performance compared to the S&P 500. That's what this chart is from Charlie Bilello of Compound Investors. And, as we can see, technology hit its peak here late last year and then has been trading sideways and then rolled over into 2021, but has since re-strengthened. 2020 was one of the best years ever for technology stocks, and 2-year returns hit their highest level since 1998 to 1999. Over the last 8 months, however, the ratio has gone sideways and tech is underperforming this year as investors look ahead to the reopening of the economy post-COVID. But basically it bottomed here in March and has been accelerating into April. We'll see what happens going forward. I'm of the opinion technology will still be providing leadership. You may have these fits and starts in the relative performance, but it's still overall, I think, will be providing leadership for the market. We'll see what happens when earnings season comes out next week and you have Google, Amazon, Facebook, and Apple all reporting. If Netflix is a guide, it may not be so good near term, but it could also be a long-term opportunity to buy on the dip. We'll see how it plays out. Speaking of 1998 to 1999, let alone 98 to 2000, this is our analog that has come, it's been doing very well here, just like the S&P 500 analog that we've been following from 2010. This is the 1998 to 2000 NASDAQ analog. We are right where we should be, folks. We got on the elevator and now we're heading higher. Is human behavior going to be different this time? We'll find out in the coming months. We're going to find that out. So far, that has held true. Semiconductors hit a new all-time high on the SOXX, the Philadelphia Semiconductor Index. SMH, not yet, eventually. But the SOXX hit a new all-time. It should be noted, though, that when it hit the all-time high, it did so on weaker relative strength. Is that a big deal? In my opinion, not necessarily. As long as the absolute reading of relative strength is still, 50 plus, you should look to buy dips in the semiconductors. And why? That's where the CapEx is going, folks. Capital expenditures they're at an inflection point with technology spending poised to eclipse hard machinery spending for the first time in history. I think you should be a dip buyer. You get an opportunity in the semiconductors historically, and we've seen the data before. We've presented it to you in past weekly State of the Markets. When the semiconductors are between 25 and 45%, have between 25 and 45% gains into October. So for the year into October, if they had that percentage of gains, historically, they are up 1 month later, 100% of the time, 2 months later, 100% of the time, 6 months later, 100% of the time, a year later, they are up 100% of the time. It's predicated upon, this is the technology, information technology era. There are more and more and more chips going into everything. I would not be surprised one day if I have a chip in my Slurpee cup, okay? Reading my drinking habits. You buy the dip in semis, tactically, strategically, and in a disciplined manner. Speaking of buy the dip, I hear a lot, there's this chatter, everybody's talking a 10% correction, 10% correction, and it's possible. I don't dismiss that. We can't dismiss it out of hand, but this particular chart shows you what retail investors are still doing. There's a lot of chatter about a meaningful pullback coming, starting in U.S. equities. But those calls need to acknowledge that retail investors, one, are very engaged with the current market, and two, are better to buy, as old-time block traders used to say. They just are. They're more, the newer, the retail trader nowadays, they're more eager to buy dips, than they used to be. It's a different cohort nowadays. This is a Google Trend US query volume chart for the search term buy stock from the start of 2018 through last week. Prior to the pandemic crisis, it is a dull, flat line. The first peak was March 2020. The second was late January 2021, which probably coincided with the whole MAME GameStop situation and what have you. As you can see, interest is picking up again though, folks. Anecdotal data to a certain degree, yes, but it isn't fitting with also the amount of cash that is still sitting on the sidelines. For all the folks that said, oh, that cash on the sidelines, it doesn't necessarily equate to, eventually going into the market. Yeah, really? I mean, look at this, folks. Look at how much money went into the market. The peak was 4.79 trillion. Got down to here at about 4.29 trillion. Had some money come out of the market, which lends you to believe there's a lot more money to come back into the market. There is still a lot of cash on the sidelines at the beginning of a new expansion cycle in a new cyclical bull market. Takeaway. Here's also something, we talk a lot about technicals. We're looking at charts. We're analyzing breadth. It still all comes down to earnings. As long as earnings are going higher, credit markets are stable, the yield curve is not inverted, you buy stocks on dips. And as we're seeing here already, the earnings tractor is heading higher. We came into this quarter with estimates of Q1 earnings growing about 24-25% year over year. That has now been positively revised to earnings growth of 30% in the first quarter. 5, almost 6 percentage points jump in just the first 2 weeks of earnings season. More than likely, it's going to continue higher. For everybody that says, oh, it's priced in, it's priced in, it's priced in. Well, then how is everybody so wrong on earnings estimate strength? By almost 6% already. We're not even halfway through the earnings season. The market is not wrong. The market hasn't been melting up the way it has by accident. The smart money knows the earnings estimates are still too low. And that's the bottom line. Thank you for joining us again here on the Weekly State of the Market. My name is Seth Golden. Please visit us at phenomgroup.com. Subscribe so that you can download our text version and review our charts and analysis alongside the video at your leisure.